Hello, in this lecture we're going to define reversing entries. According to Fundamental Accounting Principles Wild 22nd edition, the definition of reversing entries is optional entries recorded at beginning of a period that prepare the accounts for the usual journal entries as if adjusting entries had not occurred in the prior period. So we're talking about reversing entries after the adjusting process has happened. So we had the adjusting entries, and then we have the closing entries. Then we could do these reversing entries, which will reverse some of the accruals. Reason for the reversing entries are that they could make it easier on the accounting department going forward. It could allow us to separate the duties from the adjusting process and the normal day-to-day accounting process. Let's take a look at a couple examples. Here's an example of a post-closing trial balance, and we can tell because we only have the balance sheet accounts up top. So here's all the balance sheet accounts. The income statement accounts, revenue and expenses, the temporary accounts have been cleared off. We're going to imagine at 12/31 year end, we made the financial statements as of 12/31, and then we're talking January 1st, first day no transactions have happened. We then have zeros in all the temporary accounts. If we look at our reversing entries, there's a couple we may want to reverse. For example, we may have something in accounts receivable that was part of our adjusting process. This could happen if we had legal services in this case that we had done before December, but didn't send out the invoice until January. Then in the adjusting process, we'd have to say, okay, we've got to include in the accounts receivable and in revenue that $5,000 as of 12/31, the day we make the financial statements. Revenue has now been closed out, but that $5,000 is still in the accounts receivable. If we want to make things easy on the accounting department, who already issued the invoice sometime in January, we could just reverse this as of January 1st, and then once the date happens that the invoice was issued, everything will be okay. It'll look funny until that time. That's why this is something that doesn't need to happen, because it's not on a perfect accrual basis during the time period in which we make the reversal and the activity actually happens to cancel that out. So here's what it would look like. We would reverse the accounts receivable, crediting and lowering the accounts receivable, and we would debit the revenue. And that should look really funny because we're making the revenue go down. We have negative revenue. We never have negative revenue for the most part. And again, the reason that will happen is because it's canceling out a double posting rather than waiting till the date of the invoice in order to reverse it, which would be more of a perfect accrual. We're trying to separate the two departments and say the adjusting department's going to reverse anything that's going to have any impact on the accounting department. Then the accounting department can just do what they do and not have to worry about the adjusting entries. Another example of this is with wages payable. So we may have, as of the financial statement date, had wages payable on the books, meaning we owe $1,000 to employees as of the cutoff date for work that had been done that had not been paid, because we usually have the payroll department run more on a cash basis. Just logistically, that just makes more sense. Therefore, and if we need to reverse this, we really shouldn't reverse this in time until the next payroll period is processed. But if we want to separate the payroll from the adjusting process, it's easy to just reverse this as of, say, January 1st and say, okay, we're just going to make that zero debit wages payable, and then we're going to credit the wages expense. Again, should look really funny because now we have a credit balance in an expense account. That shouldn't happen. But what we're trying to do is eliminate the double recording that would happen if we process payroll on a cash basis without taking into account this reversal. And by doing it in this way, we make that adjustment right at the date, right after we make the closing entry, right on the first day of the new time period. And that's in good enough time for us to obviously create the activity for the period and then make the next financial statements at the end of the month.